Many novice traders charge full throttle into the markets with big ideas and high profit expectations, but soon find out that making money consistently is not as easy as they expected. So in this video, I want to talk through some of the biggest and most common trading mistakes traders often make. Underestimating what it takes to be a profitable and successful trader is a common mistake. Now, although it can be hugely rewarding, trading is also quite demanding. The best traders out there are the ones who committed to do whatever it takes to become a success. That means studying charts or learning new trading methods in order to prep as much as possible for what the market may throw their way. Many traders get so emotionally involved in their trades, whether it is long or short, that if the trade goes against them and they are wrong about their position, they react badly and fail to keep their emotions in check. Now, it may sound easier said than done, but try to remain objective at all times, as you'll find it will make you more intelligent when you're making trading decisions, and it will also help you avoid making emotional trades. It is strongly recommended to keep a trading diary. For example, every time you enter a trade, print out the chart and write down why you entered the trade, whether it was fundamental, technical, or a tip. Keeping a diary will help you analyse each trade, and even if you're losing money little by little, you'll notice you'll be learning from your mistakes, which in time will help you become a better trader. Money management and record keeping are just as important as technical analysis. A lot of traders enter the market assuming they will be successful, while others, particularly new traders, put together unrealistic calculations of how much profit they will make on the onset. Now, anticipating how much you'll make in advance can be very dangerous. Instead, it would be wise to enter the market with a neutral attitude. Most traders use online trading platforms like MetaTrader 4 that provide charting, research and backtesting tools to help them refine their strategies. Now, that's fine, but don't rely too heavily on these tools without a full understanding of their capabilities. Technology such as charting software or other analysis tools is meant to assist you, not think for you. So if you are blindly following mechanical systems to buy and sell, it's likely that you're not actually exactly 100% sure of what you're doing. So it is important that you understand the underlying concepts and the reasons behind what the charts are telling you. This will actually allow you to see the bigger picture and also avoid unnecessary mistakes. It's very common for novice traders to make timing mistakes. For example, a trader may have a good trading idea, but they soon discover that they bought the asset, such as a stock, at an unfavourable price. Now, timing a trade is never an exact science, but it is important to recognise that there are times when it might actually be prudent or wise to lock in a profit or cut a loss. Also, waiting until a chart pattern has been fully established can often result in a missed trading opportunity, as if you wait too long, it's often too late. Smart traders don't just look for overbought or oversold conditions, but also look for extreme overbought and extreme oversold conditions. By taking advantage of extremes, this could help traders better manage their portfolio risk. However, there are no guarantees that the current trend for a stock in an extreme situation won't continue. Placing stop orders is one way, the easiest way actually, to help protect yourself against taking a big loss. But placing them too tight can be just as disastrous. This is something many traders, novice traders, incorrectly do by placing stop orders too tight, which usually causes their position to get stopped out too early, therefore taking them out of the action before the market has actually made a significant move. This means they fail to capture much profit. Now, you should also place stops according to what the market is telling you, such as support and resistance levels, not according to your profit goals. Remember, how much a trader is willing to lose depends solely on his or her risk tolerance. Again, many traders do not calculate the risk-reward ratio of a trade before they establish a position. Now, a risk-reward ratio is a relationship between an investor or trader's desire for capital preservation at one end of the scale and a desire to maximise returns at the other end. But determining that ratio is something that traders tend to find through their own experiences and is therefore according to their own comfort level. So before you enter a trade, the first question you should ask yourself is, what is the risk-reward ratio of trading this particular asset? If you're new to trading, stick to a low risk-reward ratio, as this will help minimise potential losses. Most successful traders are constantly studying their strategy, looking for that additional edge that may actually help them make even more informed decisions. But it's also about understanding that mistakes are part of the learning process, and therefore learning to reduce them could actually help you develop a more disciplined, consistent approach to trading. Knowing when to stop and admit defeat when a trade has not gone the way you had hoped is a very important skill to develop, and early on. When you make a mistake, you need to know when to call time and continue on to the next trade, rather than holding out and hoping that the market will actually again turn into your favour, as most of the time it will continue moving against you and you'll then end up losing even more. Now, this also works the other way. Letting profits run is fine, but it's very important to establish how far to let them run. When a trade goes into your favour and you already have made a very good profit, it's sometimes good to take that profit and get out. Greed is one of the biggest mistakes some traders make. Staying in the market for too long, hoping for a windfall that will make them even richer all at once, is a very common trading mistake.